Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 6 o'clock in New York. It is Wednesday, December the 6th, 2017, and this is the Daily Report for Gold and Silver. After yesterday's dramatic fall, the fact that the markets moved quietly either up or down because spot was down a little bit and futures were up a little bit, gold was changed marginally. 1265.60, that's the closing price of Feb futures gold. Silver, though, that was down 9 cents, breaking below $16 at $15.97, and that is all with a stronger dollar. Dollar up about 0.2%, closing at 93.54. We will look at the dollar a little bit more closely during the show. Bitcoin, historical move, unprecedented move, up over $13,000 per Bitcoin, 13,546, a tremendous move in one single day. The interesting thing in today's activity in terms of gold pricing is not only did physical gold close slightly lower with futures closing higher, but in both cases, net change was limited to under a $2 move in either direction. Spot gold currently trading off by about $1.80, fixed at $12.63. Gold futures basis February closed up $1.50, $12.6640. We're looking at a daily chart. This, of course, is of February gold futures. We're looking at most active contract, along with our MACD on the bottom, moving average, convergence, divergence. So I want to focus in on a couple of factors that I'm looking at. Of course, yesterday's decline in terms of a technical move really breached a critical area, I believe, which is our 200-day moving average, and that's sitting right here. As you can see by the gray price point and the red price point, the red indicating the number for our 200-day moving average, they're pretty much equal at this point. In other words, the market opened right at but closed slightly below its 200-day moving average. And to me, that's significant because without seeing the market have the ability to form some sort of a new base at these lower market pricing, there is a high likelihood, at least on a technical basis, as well as a fundamental basis, that we could see further decline in the marketplace itself. At the same time, it must be noted that we have a clear and distinct case of a triple bottom in terms of pricing. Our first bottom occurring at the beginning of October, towards the end of October here, and beginning of November. And then again here, I'm listing this part of the double bottom as a single occurrence. And what that tells me is that this is a logical area in which a base would form on a technical basis. However, it is the fundamental factors at play that's been driving the market to lower pricing. And if those fundamentals remain in play, we would see further decline. And I'm specifically talking about the risk-on environment of U.S. equities. And U.S. equities have been moving to record highs, but they have been doing such in a way that many analysts out there believe that we could be close to some sort of a top in the market. The other thing that is clearly illustrated in terms of technical studies on our chart, we can see that on our moving average convergence divergence, we absolutely got a dead cross, and that just came in the other day, in which our shorter term moving average has crossed now below the longer term moving average. And we are getting a very similar action, the yellow line, and that represents, of course, our shorter term 50-day moving average, which is currently residing and has been above the 200-day moving average. You can see that the length between these two is absolutely moving together. And so that leads me to believe that we could see a dead cross in this market, meaning the 50-day moving average crossing below the 200-day moving average. If that was the case, that would be signaling more of a long-term market move to the downside. For right now, my recommendation is to remain flat with no active trades, a break in which we had no effective closes above this 200-day moving average would initiate a sell signal in the market. And traders, as far as silver goes, it has been showing us bearish tendencies for a longer period of time than gold has. If we look, first of all, at the MACD, we can see that that crossed at the end of last month, whereas the gold chart clearly displayed a cross just the other day. We also noticed the dead cross that came in and talked about that, in which the shorter term, this yellow moving average representing our 50-day, had crossed below the longer term 200-day moving averages. Now, the other thing that we had talked about when we looked at silver price recently was the clear line in the sand was at around 1633. It was a cross below the 61.8% Fibonacci retracement. It's a rather long retracement, but it covers the span or the rally that occurred when the market went to the low of 1513 and then traded as high as 1826. So a move below there would necessitate us looking at the next clear level, which would be a 78% retracement. And traders, what that means is in terms of a straightforward number that we would look at as a next level for silver to find some kind of support would have to be at around 1581, 1582, and that is based upon a 78% retracement. Another indication of the real possibility that we could see gold and silver pricing drift lower is simply by taking a look at some of the technical studies evident in a dollar chart. We're looking at a daily candlestick chart. It's a dollar chart with the MACD on the bottom. We can clearly see our hook, and that hook is a hook to the upside. We can also see the dead cross that came in. Again, the yellow line represents our 50-day moving average. The red line represents our 200-day moving average. And obviously, during this defined fall in the US dollar, we had the dead cross that came in right here, and then we had a widening, as you can see, of the differential between the 200-day and the 50-day moving average. We'll take a look at how it is hooked up. This is hooked down, and it does appear as though it is moving closer towards a point in which we would see a golden cross once again, and so it looks like there is some room on the upside for the dollar index. Lastly, as we have been talking about over the last couple of weeks, is Bitcoin's dramatic rise, closing above 13,000 for the first time in history at 13,100. As I said, within a couple of weeks, we will be starting up our Bitcoin commentary. That will be put out as a separate video, but as I announced yesterday, all Gold Forecast subscribers will have access to that video at no extra charge on their subscription. It will be something that will be available on the members page each and every day. So traders, up until we actually launch our trading service in Bitcoins, I do highly recommend, if you haven't yet, to begin to accumulate in a small way to your portfolio physical Bitcoins. And when I say physical, I mean digital, but not leveraged into futures markets, but where you're actually going and purchasing Bitcoins, whether it's fractional, because at 13,000 per Bitcoin, you might only want to start with a quarter or something. But I highly recommend the accumulation in your portfolio up to about 10%. I would feel, even though there's a high risk that at some point we might experience a bubble, the way this market is moving, you want to have a percentage of your assets in Bitcoins. Traders, there is absolutely no doubt. The fact that we had gold a little change today shows me that it is stabilizing. Although spot gold closed a little bit lower and futures closed a little bit higher, the key is the range defined, narrow, and it looks as though we could see lower pricing. The reason I believe we could continue to see lower pricing on a technical basis, market is still below the 200-day moving average, and on a fundamental basis, we still have a risk-on environment. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.